Okay, I'm gonna continue decomposing the net income. Okay, if you remember from last video, we ended up concluding that basically the net income is gonna be equal to a bit, right? A bit a time t. I've had forgotten to put the time, but let's put the time back. Okay, minus interest expenses at time t minus the amount of taxes paid. Okay, but now this is pretty simple. Okay, then now what happened? Another way to compute this, as we shown in last video with a specific example, we can put this one as a earnings before interest and taxes at time t, just minus interest expenses at time t, right? This is going to be the base that you're going to use to compute the taxes, right? Then the net income is going to be time t. Instead of subtracting the amount of taxes, you cannot just multiply by 1 minus the tax rate, okay, times t. Okay, here in Mexico the tax rate of here in Mexico is 0.3, that represent 30%, right? And the income, it is called the income tax. Okay, then this is a very simple formula. Okay, now let's do a little bit more math. Okay, then we can say that the tax amount that's going to be paid is going to be equal to the tax rate at some specific period times a bit times t minus interest expenses at time t. Okay, and this is going to be the amount of taxes paid. Okay, this is the base of the taxes and multiplied by the tax rate. Okay, then you have the net income plus the taxes is going to be basically a bit. Okay, then let's do very simple math to understand a very important concept in finance. Okay, then if we put this together, we're gonna see that net income, right? Net income is gonna be net income at time t. Okay, it's gonna be equal to a bit at time t. Okay, what do we have right here? Okay, then minus interest expenses. Okay, I'm gonna put it what I'm gonna do better. I'm gonna be doing this math. Okay, if you see this a multiplication of two factors, then how you multiply this one? You have this one, you multiply times this one, then later on you do this multiplication and you multiply the signals. Plus times minus is minus. It's a basic algebra, right? And then you do this multiplication, right? Okay, then this one, a bit times 1 is a bit. Okay, then a plus a bit times tr is going to be minus times plus times positive is going to be minus, right? It's going to be a bit at time t multiplied by the tax rate, right? Then we finish the first factor when we multiply by this binomial. Then what else? That now we're gonna work with this one. Is minus. Is minus because we have minus here times a positive is minus. Minus times positive is minus. Interest expenses times 1 is interest expenses. Okay, at times t. And the last term is gonna be this amount that is minus, has a minus, times minus tax rate. Then minus times minus is positive. Okay, then here we're gonna put positive interest expenses at time t multiply by the tax rate at time t. Okay, then this is a very interesting way to express net income. Why? Because here we can do a little bit more of math, right? We're gonna factorize. Okay, we're gonna factor a bit. Okay, if you remember your algebra in middle school, when you factor, then you look at the common terms, right? You have a bit here, you have a bit here, then it's going to be a bit times t multiplied by 1 minus tax rate times t. Okay, then you factorized this one, the a bit, and then you leave the rest the same, right? Interest expenses at time t plus interest expenses at time t multiply by the tax rate at time t. Okay, then this is what is very interesting. This amount, what is here, okay, we can call this one as the unleveraged earnings. Okay, why they call unleveraged? I forgot the D. Unleveraged earnings. Why unleveraged? Why? Because this is, when you talk about leverage, financial leverage, you are considering how you use a loan, right, to invest more in your company, right? Then unleveraged means that you are not considering interest expenses. Then here is before interest expenses. Then the earnings before interest expenses and before taxes, obviously you multiply by 1 minus tax rate. Then this is on the unleveraged earnings, right? Is the earnings the company made, no matter how the company was financed. If that company was financed with debt, or the company was financed totally with either shareholder equity or accumulated retained earnings from previous periods. Okay, and these called unleveraged earnings, and this is a very interesting thing. That means then the net income is unleveraged earnings minus interest expenses. Okay, expenses is what the company pays for the interest, okay, in a financial debt, okay, in a financial loan. And then here is what is very interesting. You have a plus here, okay, you have a plus, and that is adding value to the net income, okay, is adding value to the net income. Then this is called, basically, is the benefit that comes from paying interest, right? This is called the tax benefit of leverage, okay, of financial leverage, okay. Then here is what is very, very interesting that we will review in the next video.